Hi, welcome to Market in a Minute. Dag nabbit, the Nuggets just couldn't get over the OKC hump. It's too bad. It was a lot of fun watching that series. So Moody's downgraded the U.S. debt. So we think that's a very manageable issue for the markets, and I'll explain why that is. And then the earnings visibility, we think is getting better for 2026. We think there's still some downside there, but the visibility is improving that we can hit numbers close to it. And then we see some opportunities in the market. We'll talk about United Healthcare, but there's about three other high-profile consumer names that are reporting this week, and maybe we could take advantage of it. So the market update, the Moody's downgrade, went from AAA to AA due to a lack of progress on the ballooning deficits. And so I think it was just a knee-jerk reaction to, these guys aren't going to really address the budget deficit issue. And we'll see what happens there. So I think there's a lot of work that needs to be done on this bill yet still, and hopefully they cut spending more than what's being proposed by the House currently. So when S&P downgraded the debt, U.S. debt in 2011, the market actually fell about 6%. So it was a big deal. First time it happened. And then Fitch downgraded the debt in 2023, and the market shrugged it off. And it was really interesting on Monday. So Moody's downgraded Friday after the close. On Monday, the market opened down about 1% and then came all the way back. The tariffs. So we think the tariffs are a storm. They were a storm, and now it seems like it's just a cloud over the market. So it was a wicked storm, knocked the market down quite a bit. And now we think that the market is dealing with that issue. And we'll see how this plays out, but it's still a cloud over the market at this point. And then our worries, it's been the 10-year Treasury. 10-year Treasury's gone back up to close to 4.5. It's come back down just a little bit today. And so we're watching that closely. I think the market is now probably lower than we are of the 10-year Treasury yield becoming a problem. We think it's maybe the market's thinking maybe 470, 480, where it really becomes a problem. Our math is over 5% where it becomes a problem for valuations. So one of the things that we've been concerned about, and this is a big positive, is the credit spreads. So this is a B-rated credit versus the treasuries. You can see that it spiked up in a big way and it's come right back down. So the bond market is not concerned at this point about the economy. I think the bond market's more concerned about the growth rather than a recession. So we've kind of were thinking that the probability of a recession was about 60%. Maybe it's 30 or 25, something like that now with that really good GDP report for the first quarter if you X out the trade issues there. So it was a nice report excluding the trade. Now look at the S&P 500. So this is the technicals. So this is kind of like you had a dream about the market falling and woke up and his market was back to where it was, right? It's taking less time to recoup what was lost than the decline itself. So that's really unusual. Usually markets go down very quickly and then they come back slowly. We're now above the 200-day moving average, the purple line here. And so we're about 3.5% above the 200-day moving average. That's not a big deal, but given that it's recovered so strongly so quickly, we think that this is a little bit of fluff. 3.5% of fluff in the overall markets. That's not a large issue to overcome. So we think we're either going to go flat for a while or we're going to come back and test that 200-day moving average. So in terms of confidence in the earnings, we think if they pass a prudent budget, meaning not huge tax cuts, but with tax cuts and just extending the tax cuts we already have, but cutting the spending, I think the markets will see that very positively and then look out to 2026 and get some confidence in those numbers, and maybe even starts to look out to 2027 with all this investment spending coming into the United States. It's really stimulus. Okay, the budget bill. The big goal is to reduce the deficit so that it's 3% or less. Last year, the deficit was 1.8 trillion in 2024. It needs to be down below a trillion to be roughly at 3%. And so it was close to, between 6 and 7%, 6.7% is what we calculated. So that's a high budget deficit. You can see here, this is really a telling chart, really. So this is Obama, right? 2.5% deficit as a percent of GDP. And then Trump came in, it was a little higher than that when he came in office, so say roughly 3%. And then it's continued to increase during his first term, all the way down to, it was a 5% deficit of GDP when he left office. And then it's continued more, like I said, close to 7% budget deficit to GDP. So this needs to be resolved. And there's two ways to resolve it. One is to raise taxes and have a recession, but raise taxes a lot, we can pay for it. That's not the preferred method, obviously. Or we can cut taxes modestly, but then you got to cut spending. And frankly, there's two things that are driving this, and it's the interest payments. So if you cut spending, you're going to bring down interest rates, and the interest payments will be less. Secondly, and most importantly probably, is the social spending. I think the reason why the deficits continue in this matter is the social spendings have really, stayed high. So you got to cut back on some of that healthcare spending. It's kind of built into the government at this point. Frankly, DOGE has been a little bit disappointing so far. I thought they'd hit bigger numbers. So maybe there's a long way to go. Over time, they may hit 500 billion, or it could potentially get to a trillion, but I doubt it. So given the progress that they're making, I would lean much more so to the lower end of that range. And then what Trump needs to do is get this back, this budget deficit back, so it's right around here on the chart. So that's a lot of heavy lifting to do. And I think the way to do it is to really accelerate the economic growth. And actually what he's doing on getting those investments into the United States, it's huge. It could really help a lot. So if there's really is $10 trillion that's going to be put back into our economy in terms of investment spending, plant and equipment, and creating jobs, we have a shot of growing out of this budget deficit issue. Now, earnings this week. Home Depot reports on Tuesday morning, and they've done a great job. Really like the company. Trades at 26 times earnings, so it's expensive. Now, Lowe's and Target report on Wednesday. Lowe's trades at 18 times earnings, and we think it's in the early stages of turning. We think it's the stock's turning already. We think that even with the housing being dormant, we think that these companies, Lowe's and Home Depot, will see some comp store sales growth as we go through the year into next year. So it's it broke its 20-day moving average, which actually got us a buy signal. We own Lowe's, we bought the stock. Now it's broken the 50-day moving average. So hopefully the earnings are good, or at least reasonable for Home Depot and Lowe's, and both of the stocks start to improve. It's a lot more upside in Lowe's at this point at 18 times versus Home Depot at 26 times. So we prefer Lowe's. Now, looking at Target. I think Target has a Rodney Dangerfield sort of effect to it. It gets no respect. And maybe because how they source their goods, a lot of it does come from China. Maybe they're more exposed than Walmart. But this is a good company. It's not as good as Walmart, clearly. It does trade for 11 times earnings. You could cut those earnings by 50%, and that stock would still be cheap versus Walmart. So you can see that this is even earlier in its turn, just turned above the 20-day. And so, as you know, what we like to see on the technicals is well below the 200-day to get washed out, below the 100-day, below the 50-day, and just starting to break the 20-day moving average. So it's got all this buying power to come back into the stock as it starts to break out technically and back above the 200-day moving average. So we'll see how these companies report. Maybe there's an opportunity if they hiccup a little bit to pick them up cheaper. But in terms of valuations, both Lowe's and Target look really compelling to us. Now, United Healthcare, boy, this is a story and a half, right? So we've stayed away from the group. Humana had this issue last year. The Medicare programs just probably weren't bid properly, and we're seeing a lot higher healthcare costs than what was expected. So what's happening at United is the cost for the Medicare Advantage program is much higher than expected. This is what brought the stock down, from roughly 600 to 400. And then last week, okay, this is what we love. A quality company, overly discounted, and then it gets hit again. And so there was I won't call it a rumor, but a news announcement, if you call it that, from the Wall Street Journal that says that the Department of Justice is going after criminally United Healthcare. And so when that happens, that's really not a good thing to happen to a company. But the company denied that news announcement or rumor, and then the insiders all started buying the stock. So the stock went from roughly 350, 380 down to roughly 270. So it declined 26% on that Department of Justice rumor, and then it's recovered nice, a little bit off that bottom, 10, 15%. So again, what we like to see is this is unusual. This is 55%, 50% below the 200-day moving average, but 55% below the recent high. So this is a good company. Maybe they had some issues. The old CEO is coming back. Likely he'll be able to fix things. This is not a big a fix as Starbucks. This is probably an easier fix than Starbucks. Okay, here's the valuation. Trades generally around 19 times earnings. So a good growth company, high quality. At the low end of the range, 14 times. It's at 11 times. So could it go up 50% from this level over time? Absolutely. And if they get back on track, it'll go higher than that level. So we think that we bought this when it was down here, and right now we bought it for a trade, but hopefully it becomes an investment. So for whatever reason it would pull back again, we might get stopped out of it. But we for a long time, many decades, we've liked this company. And here's an opportunity to buy it really on the cheap. Just keep in mind, we are focused on 2026. The market's recovered quite a bit. We took advantage of that nicely, okay? Many of our strategies are positive on the year. And then if they're negative, they're not negative by much. So we got a shot of having a good year. We want to protect our portfolios if the markets begin to roll over again. It becomes a lot quicker than starting at a much higher level, breaking the 20 and the 50 and 100-day moving average, and then finally the 200. So the next moving average break is the 200-day, and that would, if it does that, then we would become very defensive. So we're not too concerned about our ability to protect the downside, something that we do quite often, and we do a good job at it. And we're looking to take advantage of what happens in the market. So we're opportunistically looking to increase our exposure when we can and really have a nice year. But as always, we hate to lose money. We want to protect the downside, and we're ready to do it. So if you have any questions, what we do, just ping me, come to my website, Patrick Adams CFA, sign up for a hard copy of Market in a Minute. And then if you need help with your investments, we're a money management company, and we do it with separately managed accounts. We also advise advisors as their outsourced chief investment officer services as well. Take care.